We have been hearing some terrible information about the world's economy going down the drain for most of 2022. One section of the economy that has always gotten the worst economic issue broadcast is housing. All of the information surrounding housing markets are abysmal and not encouraging. Economic experts have a lot of things to say about this issue, which is why in today's video, we will be taking a look at what Peter Schiff has to say about the crash of the housing market. Let's go. As the Federal Reserve continues to take interest rates higher, the air is gradually coming out of the housing bubble. For a while now, we have been seeing the data which reflects the fall of pending home sales, which is even a lot less than expected. They were down 4.6% this month, and the consensus predicted a decline of 5%. What's more is that during the previous months, the decline was revised down a bit from 10.2% to 8.7%. What this just tells us is that home sales continue to fall, and at this point, looking at the year-over-year report, the decline in home sales is now a record. The decline in home sales has never been this much. Not even during the crash in 2007-2008 when the housing bubble exploded. Peter Schiff says that this is now worse, and the only thing we are yet to experience is the fall in home prices vis-a-vis the high increase in inventories of unsold houses. But he says that this does not mean we would not experience them all. A crazy number of people will be seen putting their homes on the market once they realize what is going on, and most especially, where the housing market is heading. He further explains that these people will most likely want out of this as soon as they can, but the main issue is that there will be a glut of sellers and less qualified buyers. Why is this going to happen, you may ask? Well, currently, mortgage rates are above 7%, and people cannot afford to pay these prices with the increase in interest rates. When interest was around 3.5%, people could not exactly afford to pay such an amount. But they were qualified for the mortgage, and with the low payments, these people could still swing it and make payment at some point at least. But right now, they dare not swing it because they simply cannot get those low payments, as those low rates are long gone. The rates are so high now, the housing market has to reprise for higher interest rates. Peter says that the implication of this is extremely severe, as we are going to see a dramatic decline in the prices of houses. What is even worse is that a lot of people are going to think that this is good, and they will assume that since real estate prices are coming down, it also means inflation is coming down too. But they have got it wrong. I mean, stock prices are also going down, but we don't see inflation reducing, do we? Instead, it purely means that inflation is shifting from financial assets like real estate and stocks to consumer goods. There are a couple of other things which Peter brought to our attention as regards the housing market. He says that even though housing prices are coming down, it does not mean that the cost of shelter is also going to reduce. The prices are not taking a drastic increase because what matters is not how much you pay for the home, but what your monthly mortgage payments will be after you purchase the house. So you may pay less, but your financial costs are much higher. Simply put, the cost of purchasing a house may be low and affordable for you, but the aftermath, which is also the main thing, your monthly mortgage fee, will not be reduced. Hence, it is what home buyers will focus on after they buy their dream homes. So, even if the house prices are low and the mortgage interest is higher, the monthly fees you would have to pay for a lower-priced house could still very much be high due to an increase in the interest rates. What's more is that other than a mortgage, there is still maintenance, taxes, insurance, and utilities, all of which make up the whole shelter package and ultimately add to the cost of owning a home. The prices of those things will continue to increase. So, it will not even matter to a home buyer that he purchased the house at a low price in the first place, since he still has other bills to pay on his affordable home. With the reduced prices of houses, investors will be fooled to think that the fall in the prices will provide some kind of relief in the CPI, but it won't. This is because the price of shelter, which entails those other housing needs previously mentioned, is increasing even though the prices for real estate are coming down. Imagine this. The prices of the assets in your house are reducing, but the cost of living in the house is way expensive, as it is going up whenever it gets the chance to. Peter then says that given this, the net worth of certain individuals is falling, as what will happen during this situation of a fall in home prices and increase in the cost of staying sheltered is a reverse wealth effect. For most Americans, their largest asset is their home equity. As the cost of living surges, this home equity will be vanishing little by little. All of this just makes everything so much worse. At least in the previous years, as we began to see an increase in consumer prices, wealth was also increasing due to a similar increase in the prices of real estate properties, and ultimately, home equity became more. Hence, an increase in their net worth helped, and consumers did not get affected much by the rise in consumer prices. But right now, people's net worth is drastically reducing, and as such their home equity is beginning to vanish, no thanks to the surge in real estate prices. To make things worse, the cost of living keeps increasing, which only compounds the misery of various individuals. Consumers do not have the amount of wealth that can be used to ease the negative impact of higher prices, because these individuals are getting poorer as the prices are increasing, which is terrible. Peter further explains that it is even more likely that some of those who borrowed money to purchase their houses are not going to be able to pay it back. He pointed out that there is some stimulus to strategically stop making mortgage payments because it takes a while for banks to foreclose and kick people out of their homes. Meanwhile, people don't pay taxes on their properties and also don't maintain their properties. By the time the bank finalizes the foreclosure, its collateral has drastically diminished in value. So, this is where an immense crisis begins. As mortgage rates continue to see an increase, many more people will be reluctant to sell their houses because they are now closing into a low mortgage rate and ultimately would not be able to afford to take on a new mortgage. Peter says that you cannot transfer your mortgage from your current home to a new home, or can the buyer of your home assume your mortgage. They have to take out a brand new mortgage. And so, because so many people have such low mortgage rates, they are going to hold off and are going to stay in their houses for as long as they can. Nothing else will come out of this other than the fact that the housing market will be slower, which is a big problem for money lenders. So people will be stuck with a money-losing mortgage as rates are increasing. They will lose a lot of money due to this. On the other hand, for people who don't pay their mortgages because their home equity is so low, the bank will lose a lot because even after they foreclose on the property, the value will already be lost. You may think that the fact that a lot of people would avoid selling their real estate properties in this current market would make houses unavailable and maybe push the prices of houses down. But Peter made us know that it is highly unlikely for this to give the housing market a significant boost once again, no thanks to the increased mortgage rates. The fact that all of these were part of the problems of the 2008 financial crisis. But what is crazy is that this time, it will be worse than it was at that time. You may ask why that is. Well, firstly, rates were lower for a longer period back then. Also, the real estate bubble we have now is a lot bigger than the one we had back then. Right now, what we are seeing is a combination of various bubbles in the economy, which takes the crown over the one we had back in 2008. This is the main reason Peter says that a bigger financial crisis is closer than we think. He also does not believe that the Fed will not sit back and watch every single one of these things take control of the economy, but that they will try as much as they can to hold out for a long time. They might keep increasing rates to uphold as much credibility as they can. But as far as Peter Schiff is concerned, we have been led to recession now because of certain things that we have seen happening which do not occur in a non-recession period. He further says that the Fed might be delusional to think that the country still has a chance at getting a soft landing when in reality, everything has already crashed. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.